This is the Ned Group Investments Podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you.
Welcome to the first podcast from Ned Group Investments Cash Solutions. I'm Sean Seeger, the co-head of our cash solutions or liquidity business as we call it now. And I'm with Ray Wallace, who's Chief Investment Officer of Taquanta. As you know, Taquanta is our best of breed manager for cash and have been since the inception of cash solutions. Ray, how are you finding managing money in these difficult markets?
Okay, thanks, Sean. There are two aspects to it. At the moment, the income funds are doing fantastically well from an inflow point of view because obviously a lot of people are looking for yield. So we haven't seen growth like this in a long time in terms of assets under management. But as a result of that, we're finding it very difficult to get good quality assets to put into the funds. And with the situation regarding the SOEs and government's woes in terms of borrowing, it's been very difficult to get assets from those institutions as well. So you've got a lot of people with a lot of money chasing after very few assets at the moment. And what's been happening is that the credit spreads or the reward for taking credit risk has reduced dramatically. So you're buying assets very expensively at the moment. And in the low end market, in the money market space, to get quality assets at the moment is very difficult. And we're tending to have to keep very liquid at the moment, which ultimately brings the yields down. But what it means is that we're not taking excessive risk in these funds at the moment, especially with a downgrade potential later on this year. We think that keeping very conservative at the moment is probably the best thing to do.
So let's delve more into how the funds are positioned in terms of credit, in terms of duration.
So currently, we've never been more risk averse from a credit perspective.
And that's never in...
No, never, not since inception of the fund. So pretty much most of the exposure at the moment is to the big four banks or big five banks, with some exposure to some international banks. There's almost no corporate risk in these funds at the moment. And that's largely because of the fact that there's very limited amount of supply in the market. None of the corporates are coming to the capital markets for money because a lot of them are sitting on piles of cash and they've got nothing to spend it on. There are no new projects being undertaken by the usual suspects like the mines and stuff. So nobody's out there borrowing money. The banks are not lending to a lot of these corporates at the moment, so they're not really looking for a lot of money. I mean, just anecdotally, we've been trying to find assets. We put a request into one of the banks and asking them for assets in the short end of the fixed income space. And they pretty much turned us away, saying they really didn't need our money at the moment, which is something I've never seen in the markets in the entire, in my entire work experience.
What are the risks that face money market fund investors at the moment?
At the moment, the biggest risk to money markets, I think, is liquidity. And the reason for that is that we're sitting in a situation that's potentially very dangerous because of the downgrade that might be coming our way in the near future. And that, although people have been talking about it being priced into the market, in our experience, that doesn't normally happen in the short term. So what happens is you'd get a downgrade, there'd be a massive panic in a very short space of time, and people may get nervous. And often what happens in a nervous environment, people want to take money out of funds and stick them into the bank. And as I've said before, in terms of the conservative credit, the funds we're managing are almost entirely in bank paper anyway. So there would be, it wouldn't be very logical to take it out of the fund and put it back with the same banks that we have the exposure to. But nevertheless, illogical things happen in a crisis. And often what happens is people will try and pull their money out of these funds. And if the fund is not conservative enough in terms of its liquidity, then you could have a situation where fund managers aren't able to provide withdrawal proceeds to their clients in a timeliest fashion, and that can cause some disruption. So that's why we've been very conservative, not only in the credit, but also in our liquidity management of the funds. And we're sitting on higher cash balances than we would normally do in anticipation of the budget in February, as well as the potential downgrade later on in March or maybe later on in the year.
Are there any other scenarios that, even though they may have less probability of happening, that you've considered around the downgrade possibility?
Yeah, I mean, there are other aspects to the situation. So you have, for instance, if there's a downgrade and and the index funds internationally that invested in our bond market, they have to sell off their bonds in a very short space of time. So you could have a situation where there's that liquidity withdrawal, but then you also have a very weak rand, and you have a situation where the Reserve Bank may have to protect the rand by putting up interest rates. So being in a fund like a money market fund or an income fund can actually, that's invested largely in floating rate assets, can actually be a bit of an advantage to you, in the sense that should interest rates rise very rapidly, the investments that you hold within those funds will also increase their rates at the next reset of those instruments. And so you are immunized to a certain extent against a rapid increase in interest rates. On the other hand, if nothing happens, there's a potential that rates can go down, but they will go down at a much slower rate, and you will have more time to anticipate what you'd like to do in terms of your future investment views. So the downside risk is greater than the upside risk, in a sense.
So you wouldn't recommend our clients go out and fix their interest rates?
Well, certainly not at the moment, with these risk overhangs that are out there at the moment, with the potential downgrade and what might be happening in the budget. So at the moment, you're getting real yields of approximating 4% above inflation, which we haven't seen in a long time from the cash market. So there's no rush. There's no need to rush out and take your money out of cash at the moment. It's a very good place to be while you watch what happens in terms of downgrade and other risks in the market. So it's a great parking place for the time being. And then once all of the bad news is out, you can reassess your situation. But by either trying to move your assets from a money market fund into riskier assets, maybe the equity market, or into bonds, you are actually adding to the potential volatility or risk that's in your portfolio. So cash at the moment or shorter dated fixed income funds are a good place to be.
You've spoken quite a bit about the downgrade, but there are other events coming up that are on your radar. Budget, for example. Are there any things that you're really worried about out of the budget, and anything else on the horizon?
Well, I think it's from a long-term funding point of view and where interest rates are going over the long term. If we look at a scenario where the budget turns out to be fantastic and Moody's buys that and they don't downgrade us, South African interest rates are relatively high compared to everywhere else in the world. And as we've seen in Brazil, their interest rates came down quite rapidly after they had a downgrade. So comparing us against other emerging markets, there's the potential that interest rates could come down in South Africa under normalized circumstances. But obviously we're not in that situation yet because we've got this potential downgrade. So there are other risks involved in the sense that the overall funding costs of the government, of the country as a whole, could actually go up over time, especially in a budget that clearly shows that they might not be able to recover enough from taxes to be able to fund the budget deficits, and we increase the budget deficit over time, which is going to be negative for the country as a whole and for the ability for the country to borrow money. And then the cost of funding is going to go up. Again, being in a money market fund gives you that flexibility of being able to adapt to that, because if interest rates are rising and you invested mainly in floating rate instruments, you will go up with that rise automatically, and you don't have to do anything to be able to participate in an increasing rate environment. On the other hand, if nothing happens and we all end up in a very rosy situation, interest rates will come down, but they will come down quite gradually, and you'll be able to reassess the situation and then decide what you want to do, whether you want to stay in a real yield of 4% for a while and then move your assets to more risky assets. But as long as real yields are quite good, it's a good place to be. There's no reason to move.
You've mentioned different scenarios for interest rates. What is your view on interest rates?
So again, coming back to the two possible scenarios. One is the low road scenario, with us getting a downgrade, with a budget that shows that we're going to have difficulty getting enough taxes to pay for all the expenses that we have, the inability to create jobs, low growth going forward. You have a situation where you've got this contrast between rates that should be coming down because of low growth, but you've got costs of funding going up because you'll probably get a downgrade in that scenario, and then the cost of borrowing will go up. And the Reserve Bank will have to try and protect the rand. That's their main objective. And the only way to do that from a monetary policy point of view is to increase interest rates. So it depends on what the fiscal policy is going to be that's coming out of the budget. Will there be enough in it to be able to convince the rating agency to keep us on hold for a while? And again, I don't think keeping us on hold is a great thing either. I mean, if we continue this situation where we're in limbo, I don't think it's going to be good for the country, and we're really just going to continue where we are, where rates will maybe come down. Like I said, rates compared to international rates are very high, and there's a reason for them to come down in a low growth environment. But as long as we stay in this limbo, nobody's going to do anything. There's no economic activity happening in the country because everybody's sitting back on piles of cash, not using that cash. So you have this scenario where things could go pear-shaped and the rand could, blow out completely and the Reserve Bank has to put up interest rates. Or you could have a situation where we come out with a very good fiscal policy and Moody's buys that, and we get out of the scenario where we expect a downgrade relatively soon. In that scenario, our interest rates are too high and they would most likely come down over time. But I'm talking over the next couple of years as opposed to months. So this would take a long time to happen. Cash in that scenario would still be a good place to be for under the current conditions.
But yields, expect them to come down even if real yields are still very attractive.
So I would expect yields to come down over time under a normalized scenario. I would expect credit spreads have come down. So there's two aspects to yields in money markets. One is the prevailing interest rate, and the other portion is the price of credit. So the credit spread above that. And when we buy instruments, we normally buy 3-month JIBAR-linked instruments that give you the underlying JIBAR or interbank, Johannesburg interbank rate. And then on top of that, you add a spread for the specific credit risk of the entity that you're investing in. And those credit spreads have come down dramatically because of this wall of money that's buying up all the assets that are available in the country. Under more normalized scenarios, those credit spreads would be expected to rise. So they would, to a certain extent, offset any drop in the overall interest rate. But still, I think overall there will be a decline in interest rates over time. But having said that, if you look at where interest rates are now compared to where the inflation rate is, we still got a really healthy buffer for a while. So you will still continue to get good real yields on cash, and until you get to a point in the future somewhere where you may then have to change your decision on that and look for assets that are going to give you a better real yield. But we're not there. We're not even close to that at the moment.
Nedgroup Collective Investments is an authorized collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.